Papers. Okay, we're back. Hello, everybody. Thank you. We're back for round three. And Thomas Wiegelmann sends his regrets. He had a kind of a medical issue and was unable to come join us from Germany, so I am stepping in. But I love this topic. And I am going to rely on the experts I have with me up here, and also some questions from the audience, because these topics about finance, new finance models, are really current, and a lot of you are taking a look at things. So we'll have a little chat, and then we'll open up the floor and get your input as well. So we've called this Dollars and Cents, New Models for Commercial Real Estate Finance. Coincidentally, Dollars and Cents, New Models for Housing Finance, going on in track A. This is track B. So housing and the rest here. So I'm pleased to introduce Annemarie Tierney, who's the head of strategy and also general counsel for a company called Templum. She'll help us learn a little bit more about that. And also Ben Miller, who's the co-founder and CEO of Fundrise. Many of you have heard of Fundrise. We'll get an update on what's happening at Fundrise. So Annemarie, can we start with you? Tell us a little bit about Templum and what you're working on, and then we'll dive into it a little deeper.
Sure. So Templum's a New York City-based broker-dealer and alternative trading system. And for most of you out there, you're probably not securities lawyers, so I'll try to keep it a little bit more interesting than some boring legal terms.
No, why would you say in one sentence that you can stay in 12 pages? Right.
Well, heretofore and thereafter, I will talk more succinctly. So what we do is basically we have an investment banking model to help issuers raise primary capital in the private unregistered security space. We have a specific focus on real estate, credit instruments, intellectual property portfolios, so things that are typically harder to find liquidity for, but provide yield. And so we did a deal that some of you may have read about last year, which was a sale of the St. Regis Aspen Hotel. $18 million were sold by the owner of the hotel. What's, I think, a little bit unique about the way that we structure things is the securities are represented on a blockchain. So they're not tokenized securities, which is kind of a buzzword these days. I'm going to tokenize things, and they're magically going to become investable or generate higher valuations. But we take a really thoughtful approach to representing ownership of shares that are issued through our platform in a private permissioned blockchain protocol. So it's kind of a really interesting step up from a typical book entry share ownership record. But the beauty of that structure is that we also have an alternative trading system that's one of only two in the US that's specifically approved to trade unregistered securities that are digitized. And the blockchain element allows us to build in parameters into a smart contract, which is just kind of like a sourcing protocol on top of the trading model that allows, for example, a REIT can't have less than 100 shareholders. A private REIT can't have more than 2,000 shareholders without having to publicly register. We can build all of those parameters right into the smart contract. So it's kind of...
So that it's automated.
Automated. Yeah, it's fantastic. Our platform is closed. Right now it's only available to accredited investors. Mm-hmm. Most of the issuers we're dealing with are really looking at that institutional buy side as opposed to retail investors, at least in our space. And we see real estate as a really critical sector for us going forward in our business model.
Thank you. And I want to come back to the distinction between, we'll come back in a moment, to the distinction between the tokenization versus blockchain, which is a technology that enables a bunch of stuff. That sometimes gets in the mix and confuses people. So, and I'm a novice at this, so we'll come back to 101 in just a moment. But Ben, so tell us a little bit about how you've been approaching with Fundrise, also maybe when and how Fundrise started versus where you are now.
Okay, so Fundrise, it democratizes investing into private real estate. We are how the mass affluent does, and I believe will invest in private real estate. And just to give a little bit of background on us and the sort of idea for the industry, if you will, back in 2012, the government, the Obama administration and Congress passed the Jobs Act. It changed the regulatory framework for how one could invest in private securities. And over that period, there was sort of this interesting buildup of sort of how would this affect real estate industry. There was yesterday people talked about this, the hype curve, Gardner hype curve. There was a period of a lot of hype, a lot of promise. I think at this point, most people are now thinking that it was overhyped and not sure how it's going to affect the industry. And then out of that comes this, I think, a lot of change that will happen to the industry, but only after people have stopped focusing on it, I think we'll actually start to really have the impact that it could have.
Because I think when I remember we had a list of something like 150 real estate crowdfunding startups, which you may be one of the 3.5 that are left. And how many of those really were crowdfunding? Can you tell us what's crowdfunding now versus what it was kind of promised to be?
So I mean, I don't think it ever had a very clearly defined definition, but the idea was use technology for real estate finance. What happened over time was that the space segmented into different, in a way it models the ordinary industry where you'd see there are people who are investment banking or fundraising. There are people who are acting as principals or fund managers, which is what we do. There are people who are providing software solutions. So they ended up basically different models developed in the space. And then basically over time, there's only really 1 or 2 players in any one of those models left.
Mm-hmm. So in layman's terms, you're a fund, and I can buy shares in the fund.
Yeah, so we're a fund manager.
You're a fund manager.
We have a dozen funds that are private real estate fund.
Do I have to be institutional money? Are you still, you're B2C or B2B?
We're B2C, yes. We're fully democratized. Anybody can invest over the age of 18.
Okay, great. So that's terrific. Thank you. As a kind of an update on where we are with crowdfunding, and we'll come back to that. So Annemarie, can you share a little bit about, you're in a couple of different areas. One is a securitization story. Maybe or not at this point what you would call tokenization. Can you make that distinction for the audience about can you explain tokenization to the audience?
Yeah, absolutely.
Even though you don't do it yet?
And I'll explain why.
Okay, perfect.
Yeah,
Good.
so I can explain what it is and why we don't think it's the right way to go.
Okay.
So I have to assume that most people in the audience are familiar at least with cryptocurrencies, Bitcoin, Ethereum, kind of potentially you're familiar with the fact that about $1 trillion was raised in 2016, 2017 in things called initial coin offerings, which were basically startups in the blockchain space raising $1 trillion basically on a white paper without a business model. And oddly enough, the SEC stepped in and said, hey, these are securities transactions. And, most investors in those transactions lost all their money because the companies never got off the ground. And
these weren't only real estate. This was all.
This is across the entire market. This is not real estate. Okay. I'd say for the most part, they're blockchain kind of oriented companies.
This was sell tokens, give me your money, I'm going to build some kind of a business.
Some kind of a business. Yeah. And they failed. And so the SEC stepped in and said, these are actually regulated transactions. If you're selling an interest in a company, it's a securities transaction, and they need to be regulated and done pursuant to SEC rules. So then a new breed of and this was initial coin offerings. This is the ICO space. So then a new breed of companies started issuing what were called tokenized offerings. And the token could represent a common share in a REIT or another kind of investment vehicle, an LP interest. But that interest was represented on what's called a public blockchain protocol. So the same rails that were used to reflect sales of Bitcoin or Ethereum or cryptocurrencies were being used to represent securities transactions. And I'm not a tech person, even though I'm the head of strategy for a tech company, but there was a weird game called CryptoKitties that was like buying interest in kitties.
Anybody buy CryptoKitties? Any CryptoKitty buyers? No?
Good. Okay.
You look like a CryptoKitty buyer right there.
I think Minta had a couple, but
Minta had a couple?
She's not going to acknowledge that. So CryptoKitties was like almost like a digital pet toy but people spend insane amounts of money to buy these stupid kitties. And
Oh, okay. Where are the cat people in the audience?
what were those things you could buy like some decades ago that like were like a little fake pet, and if you didn't feed it, it died, and then you felt really bad. So it's kind of like a digital game, but it brought down the Ethereum network. Like literally, it crashed.
Crashed the whole thing.
Crashed the whole system, and so we started thinking. My CEO. Chris always says, if something can be crashed by CryptoKitties, like seriously, do you want your security
real estate
transactions
in there or securities? Yeah.
to be traded on that? And because we're in the private and registered space, there's no typical infrastructure for securities clearing and settlement, right? The DTCC is not a part of our framework or our infrastructure. There's not traditional transfer agents in our space. There's not traditional custody solutions in our space. So we decided we're grown-ups. We wanted to run a regulatory business that made perfect sense to the issuers that we were working with. Right. So we started thinking, okay, well, most of these tokens are issued on something that's called ERC-20, which is a variation of the Ethereum protocol, publicly registered. Identities are anonymous, but anybody can see the securities transactions happening on the public blockchain. And we thought, that just feels wrong to us. And we're, as I said earlier, we're the only broker-dealer and alternative trading system that's approved to transact in the digital asset space for both primary offerings and secondary. And we started thinking, okay, if we're going to be working with regular investment-grade issuers and institutional investors, we want the blockchain element of the transaction to be like not an issue. Right. So
because there's all of this noise about crypto and blockchain, and is it safe to say that nobody here will really ever have to do blockchain? It'll just be part of the system.
Does anybody here own securities in a public company?
Anybody?
Okay. Does anybody in this room know whether those securities are represented by a piece of paper or a book entry?
No.
No, of course not. You have an account at Schwab or TD Ameritrade or Merrill or someplace, you have no idea what the infrastructure is behind the ownership.
And
you
I
just
don't really
know you
care
own
as
it.
long as it works.
Exactly right.
When it's secure.
And it's secure. So blockchain is just a different version of share ownership. The state of Delaware in 2017 changed its legislation and said if you're incorporated in the state of Delaware, your share ownership can be represented by a certificate. So get your little Disney certificate with the cute little pictures on it, which I don't think they do anymore. Book entry, which just means a fancy Excel spreadsheet, right. Or blockchain. Oh. So it's completely legal way for a company to incorporate and represent ownership now. Delaware is silent on the version of blockchain that suits its purposes. But what we decided to do was create an infrastructure solution that looks and feels like a traditional private placement structure with a trading system that's unique in the space, and just put the blockchain protocol underneath it. And again, what that does, as I said earlier, it just allows you to program trading. Say you only want institutional investors, so accredited investors are better to buy.
So you can filter with it.
You can filter. So it's called whitelisting and blacklisting. Right. So whitelist means these are all the investors who can buy. Blacklist is these who cannot. So it's just kind of an algo. Is
Templum doing this with non-real estate assets, or are you focused on the real estate class?
We're focused. We were not originally focused on real estate, but what we realized once we did the St. Regis Aspen deal on the primary side is that there are a lot of institutional investment vehicles right now, funds, some REITs that are doing redemption, right? So in order to, in a private structure, maybe a fund is doing a redemption on a quarterly basis. If you provide secondary liquidity to your investors in a different format, then you don't actually have to offer that redemption.
You don't have to do the redemption.
So you can keep your assets under management in your own fund and not build that periodic tender offer at NAV into the system.
So we'll come back to
that's when we started thinking real estates, and the real estate market is obviously a tremendous opportunity for...
We'll come back to the secondary, because I think that's intriguing about liquidity. We're going to talk about liquidity. Ben, so tell us, just walk us through what it looks, does it still look the same way with what you're doing as far as how you take on, how do you onload an opportunity, and then how you reach out to potential investors? Has that changed much?
Well, I think that the insight Annemarie had, which was right on, is that the underlying technology isn't what matters. It's ultimately, is the product better? Is it faster? Is it cheaper? And that's what took us a long time to realize that, for the customer, so we have, 100,000 investors approximately. They transact through their phone. It's really easy. It's really low cost. And so they own private real estate that wasn't previously, people didn't own real estate. People owned stocks and bonds. And so how you do it doesn't matter. How does a fuel injection work on my car? I don't even know what it is.
It just starts.
It just works.
We push the button.
It's better. So what we discover over time is the investor wants from us the simplest, as low risk possible solution, with low fees and ideally great returns. How we do that is basically our problem, not their problem. So we used to, when we started in 2012, we posted a deal, one of my deals as a recovering real estate developer, on the internet and raised money for it. In a way, a lot of real estate people followed this evolution. You do a deal, you raise money for it, you start doing multiple deals with a syndication network, and then you become a fund manager. Because being a fund manager, a vertically integrated fund manager, is a lot better than being a syndicator, which is a lot better than just being a single real estate asset developer. So, there's like an evolution to how...
Does everybody agree with that? Probably follow the money?
Having a fund that you basically have a proprietary capital source that you can deploy into deals, whether you do it... We do direct deals, we do joint venture, we do lending. We basically have a lot of flexibility. That's a better business than, putting a real estate deal up and hoping you raise money.
So is there a secondary market for you? If I'm in that, can I get out of that? If it's not some kind of a REIT structure?
Yeah, so our product basically, for the legal professionals here, it operates like any other fund where you have approximately quarterly redemptions. So someone literally just goes into their app and pushes they want to redeem, and 60 to 90 days later, their money typically returns to their account. We have gates, so if there's a 2008 financial crisis, we can say, well, that's probably not advised for the fund. So the way liquidity works for us is less about what's the liquidity of the asset, but with 100,000 or 500,000 or 1 million investors, arguably we have a decent amount of liquidity in a different way than a person thinks about a real estate deal.
But you have quarterly liquidity.
Well, it's actually on a 60-day rolling basis, but it's like quarterly.
But not quite as, so now what might the future look like if we have this dynamic, transparent, fluid secondary market? Is that how you see the future, Annemarie?
I do, but part of my background is I worked at the New York Stock Exchange, and I also worked at NASDAQ. And so if you want real liquidity, you're not going to beat the public markets. But what we provide is liquidity, right, where there is no liquidity. And right now, for companies like Ben's, I think your only option for public liquidity would be to list on OTC, QX market maybe, and get a market maker and get
Or you just go public.
Or you go public, right, of course. Those are your two options. But this provides another type of liquidity. We can't promise that digitization is going to make your asset investable. Your asset has to be worth investing in the first place. But if it's the right asset and is providing the right return or the right upside, then we have a pool of institutional investors who are looking to come onto a platform. It looks a lot like a bulletin board market where it's bids and asks and real-time quotations. The other thing that's, I think, very atypical about what we've done is that we are S&P CUSIP's digital security partner.
Say that again.
S&P CUSIP.
Okay.
So CUSIP number is an identifier that every security in the public market has. You may not even know what that is, but if a trader is looking to buy or sell your security, they'll go into a terminal, usually operated by Bloomberg or Reuters, and they could put in the identifier of your security and pull it up and see what the price is. All the securities on our platform will have that CUSIP number, so they're searchable, and we're the only market that offers this in the private space. They're searchable by your typical trading facilities,
right,
which will provide even more liquidity opportunity. But it has to be an asset worth investing in. So we're very careful about who will list.
And Ben, I'm sure you would say the same thing. You only want to do assets that are worth investing in.
Yeah, that was an early decision we made, and I think that for us was the right path. There are some platforms that are open platforms, and that the idea is a real estate company puts their fund or deal on the platform. We felt like these basically were our customers, so we had to be ruthless about owning the execution. So that's why we thought be more like a fund manager, where you own the results, you make the investments, and in a lot of ways, just like Annemarie is saying, to the real estate industry, we look like a real estate company. We have joint venture deals, we have loan agreements, we have bad boy guarantees. But to the customer, we look and feel like Instagram. and that's so we're half our organization are real estate people coming from Prudential or some fund manager, and half our organization are software programmers who think about the customer, and the interesting that creates interesting opportunities for us as we think about the real estate industry is a B2B business basically, and over time, if you look at what software has done, most industries is made them B2C. Because ultimately, a B2B is, in a way, a middleman. And so, like, if you think about people like institutional capital, well, most institutional capital are pension funds. And guess what? That's retail. So it's really a construct. And demographically, nobody under the age of 45 has a pension fund. So what do you think are going to happen to pension funds? They're going to go away. Everybody in this industry raises money from pension funds. And that's basically like saying, I live in the desert and I have a stream, that stream's going to dry up. And then basically what's going to happen to the village. So this change will be very interesting to see how it affects the real estate profession.
Okay, so this is interesting. Just to revisit this. So if we've got an industry that gets a lot of their funding from pension funds, and anybody under the age 45 does not have a defined benefit pension fund, what's that going to mean in the future, in our lifetime in the industry, when that source of capital dries up? There will be other sources, but your argument is, why can't we just go right to the source? We'll go right to the consumer.
Well, so that's playing out now, and so I have a presentation I did at ULI about that. So basically, every pension fund that you know of already has this demographic dynamic. They're getting more money leaving than coming into it. More people are retiring than entering the workforce. The baby boomers are hitting the retirement age, and so the public and corporate defined benefits plans are losing $100 billion a year.
Wow.
So it's just like, to me, this is like the next subprime mortgage crisis, because underneath most of the public markets is the pension fund industry, whether it's block trading or it's real estate, block trade institutional investing. So that is going to have a huge impact on every single person in the sector.
Right.
How that plays out, that's an interesting thing.
Okay, we'll find out. So I'm going to come back on because I want to walk through tokenization.
I just want to say one thing.
Sure.
I completely agree with you that it is not sufficient to just put an offering up on a platform and expect it to sell, which is why our model is a typical investment banking model, which is very, very high touch, very bespoke outreach to sovereign wealth, institutional investors, and other type of institutional distribution partners. So I completely agree with you. Like, just putting something up on a platform is not going to sell your offering.
Ben, can you comment? I remember the headline about the E-REIT. Can you just explain to me, was that what was novel about that, or was it just a new name for something we were already doing?
So when we moved from doing deals to doing funds, we created something we called an E-REIT, which basically is a REIT from a tax point of view, except for everything we do is on a digital platform. It's funny. People always tell me that, like, oh, I can't believe you take investors who write $1,000, $500, $1,000, $2,000 into your platform, and I say, oh, the worst is $100 million. If anybody has ever had a $100 million investor, that's way worse than having 100,000, $10,000 investors. Or
really, because the narrative a little about why crowdfunding struggled a bit was that the realization that managing 1,000 investors was different than managing 10 investors. So you're actually kind of claiming the opposite. Suggesting the opposite.
It's not like anybody here can walk into a room and manage 100,000 investors. You have to build an organization that does that. So we have, we're 100 people. We have 1 million users and over 100, basically over 100,000 investors, and we're growing rapidly. And how big is that? I mean, how many people essentially could be an ordinary investor in real estate? It's tens of millions, maybe hundreds of millions. Maybe 20 years from now it could be 1 billion people. So it's a really, really, really deep reservoir. Blackstone and Brookfield are huge organizations, but Schwab and Vanguard and Fidelity and BlackRock are much, much bigger. Retail is much, much bigger than institutional. It's just not how, since basically 87 when everything changed, and it's not how real estate transacts anymore. It used to be the norm.
So did I miss anything on the E-REIT? So it was a sort of a repositioning of.
It's basically a technology platform with a REIT, a real estate investment trust framework.
Okay, good. Thank you on that. So I was always curious about that. So thanks for asking that. Annemarie, can you just briefly walk us through what I know you're not doing kind of the tokenization that's out there being talked about, but what might that look like? How do you think about that? You've got an asset, you want to create liquidity, and you say, oh, I heard about this thing called tokenization.
Well, why don't you say that you've heard of something called digitization,
okay,
and then we'll be on the same page.
Okay, I've heard about something
easy.
called digitization. Walk us through digitization.
So basically what it boils down to is the issuer's share ownership records being represented in that blockchain protocol that I mentioned was legal in Delaware now versus book entry. And one of the things that we've done to add more kind of comfort to our infrastructure solution is that we were approved to operate a U.S. registered transfer agent. So that transfer agent sits on top of our trading platform so that while trades happen all day long kind of through and represented on that blockchain, at the end of every day, those trades are, sent back up to the transfer agent, so adjust the books and records. Investors have actual paper versions of executed subscription documents and purchase and sale agreements. So if you need something for custody purposes, you're going to sign all your investment documents on our platform electronically, but you can download them and have hard copies of those the same way you would in a typical investment structure. So basically all it means is at the end of the day, if you're an issuer, you can say, okay, I need to set these limitations around my trading. I've approved who can sell and buy my securities. That will happen kind of like it does right now in a way that you don't really see through the DTCC, except it's done through our platform. So digitization, again, what it provides, we think, is a real opportunity for liquidity in a much different way in the private space. Right now, most private company or private issuer liquidity is block trades, or I want to sell interest in a fund, I have to redeem, or maybe I'm in, there's a distressed situation, and so the GP allows me to sell my interest to another LP in the fund. This is just another way to provide a different and greater level of liquidity, again, based on the value of the asset.
So I'll ask an even more basic question, and also I might toss out to Minta K, who would know this. I've got an asset, so I've got a hotel in.
Can I add one thing?
Sure.
Okay, you could also fractionalize your ownership using blockchain.
That's the part I wanted.
Okay.
I was curious to know about. So
Okay.
I've got this asset. How do I assign these? I know you don't want to. How do I assign this digital stuff to my hard asset in a way that's legal that now I can slice and dice the asset? How does that work?
So I've bought 100 shares in your REIT, right?
Okay.
I can either sell, and I want to sell 50 of them. That's not fractionalizing, that's just
Right.
selling 50
That's
shares.
selling a REIT.
So fractionalization could mean that I'm selling half a share. Would you want to do that or not do that? I don't know. Fractionalization, that concept to me makes more sense around cryptocurrency, where maybe you have a Bitcoin that's worth $8,000 and you want to sell $3,000 worth of it.
Right.
A real estate investment or another type of security investment, if you want to sell a half of a share, you could do that through our platform if you're just looking for some kind of return.
So some of the
But
promise.
that's the kind of fractionalization. Fractionalization in the securities industry is a little bit different than that concept in the crypto industry.
So, and Minta, maybe you can answer this one. Am I able, say I've got a $100 million asset and I want to draw 20 million out of it, can I issue 20 million red tokens and sell them on her exchange? I mean, is it that simple or not?
You can sell, the owner of St. Regis Aspen sold 20% of its ownership through our platform. So you could take one asset and sell a portion of it. You're just going to make that portion common shares or some kind of equity instrument that somebody can buy.
Okay,
The fractionalization of the asset is different than the fractionalization of the securities that you purchase.
Right. So the distinction between the divvying up the asset
Correct.
specifically versus divvying, because I know in the
Sorry,
crowd.
and Minta, I'm sorry.
Thanks. Aaron, can I get the mic in a moment? Thanks. Because this came up in crowdfunding, you mentioned the different models. There was the co-invest model, the fund model, the pass-through platform. There were different versions and variations, and so I'm wondering if maybe we're going to see different types of structures going forward.
Where we see another huge opportunity is, say you're a family office and you own a sports franchise, and you're thinking about estate taxes and how are you going to pay the estate taxes and still maintain ownership of a farming industry or some single asset that's very, very valuable. This would allow you to sell a portion of that asset interest and pay those taxes. So that's the fractionalization of the asset. Absolutely makes sense to us.
Okay, that's good. That's a good distinction. And so, Minta, do you want to just comment briefly on just the kind of legal, is this complicated? Do we have law in place to do this, or are we still kind of figuring it out?
I think that...
There's a mic there for you, Minta.
Thank you.
Minta Kay from Goodwin. Goodwin does a lot of work in this space.
Thank you, Steve. Not overly complicated, but there's a lot of regulatory hoop jumping to go through.
Right.
Annemarie knows that quite well. But it
Right.
can be done, and we're seeing an increasingly large number of groups trying to do it not just across asset classes, but within particular assets as well. Can be
Right.
done.
Right.
The regulatory burden is mostly on the broker-dealer actually wanting to provide the service. It's not a burden on the issuer. For the most part, it's just a disclosure point.
That's correct,
in your
yeah.
prospectus or your private place memorandum.
Right, so if I don't have to be a broker-dealer as a real estate person
Absolutely
if I want to fractionalize an asset.
That's correct.
Now, if I wanted to trade on your secondary market, or I want to somehow loop it into Fundrise in some form or another as a tradable, then we're talking a different regulatory scheme.
Well, it's so at the end of the day, the SEC doesn't define a digitized security as anything other than a security.
Oh, right.
So there's nothing different. You're still buying common stock in a REIT or an LP interest in a fund. You're buying what you would have bought previously, same rights and privileges, same distribution preferences, all of the things that you would have bought in that investment vehicle are exactly the same.
Right.
It's just that there is a blockchain representation of your ownership on the platform to allow you to trade much more simply than you can right now.
So Ben, have you been?
Minta had a...
I did, Steve. I was just going to say that fractionalization on the security side is different than probably what some people who are real estate folks in this audience may be thinking about in terms of recapitalization on the straight real estate side, which Ben's group can do just like any other straight real estate developer can. So that's a different concept that you may want to clarify.
So that was my question for Ben was, do you see in this new technology, are you considering, does it give you any advantage, or is the current system that you've mastered, is that sufficient going forward?
So the advantage so there's obviously an advantage in having a lot of people as a customer efficiently. And so if you think about it, most funds, most private equity funds are really an interface between the entrepreneur or developer and institutional money. And so we're just that, except for our capitals from mass affluent. But the application of technology and sort of innovation to the idea is not. I mean, what we're seeing is not so obvious. What power could happen? I mean, so in real estate today, the biggest challenge is deals, not dollars. Opportunity is the scarcest asset today, and so how do you get assets that basically will perform today? So we are one of the things we're working on is that in most cities, if you have a great real estate deal that you need to build, it's very difficult to build it. Entitlements are a nightmare. If you ever try to build anything in San Francisco or LA or a major metro market other than in Texas, it's difficult. And so, if you're a sponsor, if you've ever done this, maybe you get some friends to show up to a community meeting. Maybe you get 5 people, get 10 people, and they show up and they try to convince people that it's a positive, the positive development. We can bring thousands, tens of thousands. So we can completely transform the dynamic of development because the silent majority previously were not invested, literally, and not engaged, and we, since we're a platform, I can literally open them up right now, look at what's happening with my real estate assets because we give people real-time content. We can transform how development works, and so that's not an obvious implication of the innovation, and that's not something you can just go build. It comes from scale, or what you call a network effect. Mm-hmm. That's just one example of how we're trying to do things a little differently.
Great, thank you. So, questions from the audience. We covered a lot of material, a lot of ground, a lot of ideas, concepts. Questions from the audience? I especially want to hear from the capital people in the audience. People with experience with crowdfunding, or have you done tokenization? No tokenization yet?
Nobody wants to tokenize.
You're out on the cutting edge.
Tokenization's the worst. Don't tokenize.
No, I'm sorry, I used the wrong word. Digitization.
No, it's I think if it was 3-4 weeks from now, I would be able to announce, like, we're working on a deal right now that's about $750 million private REIT. That's a triple net lease-based REIT with mostly commercial and retail properties. I think once you start seeing these deals and you understand the value of permanent capital versus needing to redeem or offer kind of liquidity in other ways becomes a lot more meaningful. So I think if we're talking about this next year, if we're having this conversation again, you're going to be using the word digitization, and 5-6 people will have raised their hand, and a year after that, maybe 20.
We try to be early on this, and
I love that. Yeah,
we try to be as early as possible. So, did you notice an increase because there was press on the St. Regis?
Yeah.
Did you notice an increase in inbound?
Yeah, people are really interested in the idea that in order to get value out of an asset, you don't have to sell the entire asset. So that fractionalization of the ownership was really compelling. We had a pipeline of something like 400 issuers that approached us to help them raise capital, but were very curated. And again, we only want to help issuers raise capital where we have an absolutely solid distribution channel. That's the difference between kind of throwing up on a platform and hoping that it sells. So we've spent time since that deal identifying deals in the pipeline that are the right level of investment for our distribution channels, and building distribution partnerships with your traditional players in the space, banks, funds, families, and that sort of thing. So I think, again, like, if we're talking about this next year, the market will definitely have gone from nascent to at least 1 or 2 levels up from there.
Ben, if we're talking about this next year, what will you tell us that's different from this year?
I don't know if this changes in a year. I think that there's the 2 major drivers are macro environment and how long it takes for technology to really drive change. I remember back in 2003 or 2004, I used Amazon, but I never really understood what it would do to retail, and I was a retail developer, so not anymore. So you don't really see change in finance without a recession, until basically there's a macro shock and we see a lot of capital dry up. Nobody's really going to change, and at the moment there's capital everywhere, and so there's people are thinking about technology, but I don't think they feel threatened by it. Over the longer term, just to me, it's like obvious in the next 10 years, the generation that is Generation X and millennials will be the source of capital. Today, basically, most real estate capital comes from baby boomers and silent generation. So if you were in a room with a bunch of people from big fund management firms, like their customers over 55, over 60, definitely, maybe even over 65, and their customer not 30. That's just not where their money comes from. But that's obviously going to change, right? It's that today's young people are tomorrow's old people, and they're not going to use the old-fashioned platforms to how they invest. It's just like that's not. It's just like you think you consume media the same way or news or so. It's going to this demographic change is destiny, and fortunately we're trying to get ahead of it.
One thing I think is really interesting about what you just said is part of what we saw in the private space around private companies, we've been talking about a little bit in other contexts, is the fact that companies are staying private so much longer. And so instead of going public at 7 years, which probably a successful startup would have done 15 years ago, now you see a company like Uber going public with an $80 billion valuation, right? So most of the upside of that investment occurred in the private market space with early investors, VC funds. What that means is that even if you don't have a pension, your 401k plan isn't getting access to that valuation until after it's public.
Yeah.
So I think that most people who are in that space where there's no pension, who have 401k plans that don't get access to the real upside of public company investing, are looking for yield. And real estate is like such a great opportunity in what you're doing of democratizing investments in real estate and allowing people with small dollar numbers to get in and actually find a way to get value without owning an entire house and hoping they could pay the mortgage and then selling it in 40 years. I think that's critically important to the ability for this generation to have enough money to live their lives and retire someday. I mean, I just think it's really, really compelling.
Yeah, I mean, the public markets today, like the REIT industry, which I'm not a deep expert in the REIT industry, but you look at it, now that it's part of the index investment funds, it's priced. I mean, basically the yields are yield and equity. Most of the REITs are 3s. And if you go buy private real estate, you can buy unlevered, maybe 4s or 5s. I mean, I say for a quality asset. So you're talking about a pretty decent premium to be in the public for that liquidity, but be in that public context.
At the cost.
And the liquidity premium has a cost. And it's strange to me that you would be in a 401k for retirement and have an absolutely liquid investment. That just makes no sense to pay liquidity premium for something that is
When you don't need it.
It's a multi-decade investment.
Right.
So I think that the big fund managers are like, because of demographic collapse of their traditional financial source, they're gonna probably convince Congress. They're gonna move heaven and earth to get into those 401ks because they have to. Otherwise, their business is gonna decline.
Wow. Okay, you heard it here, but we do have a question in the back. Do you have a question in the back?
Thank you.
Quinn, thank you.
Yes.
Quinn from Jiaiming.
Yeah.
Yes.
Hi. You guys talk a lot about raising capital, but could you talk more about your exiting strategy? Would you rely more on liquidity or rely on institutional buyers?
Exit strategy. Right? Exit strategy, Quinn?
Exit.
You are an exit strategy.
Yeah, we provide an exit strategy. I think maybe that's geared more towards you.
Okay, I mean we have a decent amount of AUM. Our investors are to the extent they want liquidity in the short term, they can do it basically clicking a button. We sell assets. We think it makes sense. We refinance. We get lots of refinancing. We get supplementals from Freddie, Fannie. We occasionally sell. We 1031. I mean, it's how you get liquidity depends on the situation of the asset. And then if somebody comes in and invests $1,000 and gets 47 assets in a diversified portfolio across 5 different funds and in 22 geographies, the liquidity around that's fundamentally greater than the liquidity of a single asset. And so, that's what the public markets are all about. Basically, if you have many assets and you have many investors, you get more liquidity and basically you get better returns. I mean, it's diversification not just of what you invest in, but who your investment comes from. And that's actually essentially the definition of a marketplace of liquidity.
Any other questions? We have a question down here.
Yeah, you made a very compelling case. That
Can we, we'll wait just a moment for the microphone so that everybody can hear. Thanks, Aaron.
I'm Brian Sanchez. I'm with one of those fund managers that invests institutional capital, and we recognize that the capital aggregation model is about to change radically. I'm curious what you think it's going to do to the built environment. What are we going to build, if anything, differently, given that the capital source is going to come from a different place? It's not going to come from these big institutional blocks in the future.
Wow, so when we disrupt the capital ecosystem, does that impact the manifestation in the built environment?
I mean, that's where I started, because when I first started doing a deal in an emerging neighborhood, I thought it was strange that people who lived in the emerging neighborhood couldn't invest in it, and my money was coming from New York. But exactly how that plays out is actually much less clear to me now that I'm like much further along. The consumer is obviously different than a pension fund advisor. A pension fund advisor, how you invest someone else's money is very different than how you invest your own money, and being able to communicate with people. I mean, that's we've always been trying to figure out, how do you communicate with somebody so you can get them to do something that otherwise an agent wouldn't want to do, because there's too much career risk in the nature of an agent. And they always want to do the thing that's safe, not the thing that's on trend. And on trend is really one of the best ways to make money in real estate. And the consumer is the trend, right? So the investor is the consumer, so maybe they're more on trend than a pension fund advisor. But we are like deep down into that how do we do that? And it's only become possible it's only becoming more possible as we get scale. You need a lot of people to be able to get to building. I mean, building a massive project requires a lot of capital, a lot of time, and a lot of information.
And if digitization gives us even more liquidity and more velocity and more flexibility, that will in turn also influence what gets built and how it gets built and where it gets built.
Well, it could certainly influence how much primary capital is raised around a project if they know that they'll have some sort of exit on a negotiated price basis.
Wow, terrific. Annemarie, Ben, thank you very much for a terrific conversation. Let's thank them.